The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. I hope you're all doing well. I'm just going to do a quick sound check before we start the webinar at 1:30 Eastern Time. If you can hear me, please click the raise hand icon in your webinar control panel. Perfect. Thank you so much, everyone. Okay, everyone, I hope you're all doing well today. We're going to get started right now. My name is Sarah Clark, and I'm a program coordinator with CIPH. Welcome to today's Outlook Economic Forecast webinar presented by CIPH and HRAI. I'm pleased to note that we have a total of 370 sites registered across Canada for today's session. Before I introduce our webinar presenter, please note that you will have the opportunity to ask questions at the end of today's session. You can do this by typing your question directly into the question box you see in the webinar control window on the right-hand side of your screen. Please save your questions for the Q&A portion at the end of the session. Also note that a copy of today's presentation will be made available to all attendees following the webinar, and you will have the opportunity to submit questions after the session has ended. Today's webinar presenter is Peter Norman. Peter is Vice President and Chief Economist at Altus Group. Altus Group produces a publication for CIPH and HRAI called the Outlook Quarterly Economic Review, which delivers timely economic insights, housing market data, and commentary and analysis of trends in non-residential and infrastructure investment by region in Canada. Peter is a well-known professional land economist and forecaster who is widely quoted in the Canadian media and is a frequent expert witness on economic matters. He also consults for private and public sector organizations across Canada, providing economic intelligence and strategic advice. Ladies and gentlemen, please welcome Peter Norman.
Well, thank you very much. Thank you, Sarah, for that introduction, and thank you, everybody, for being on the line. It's always a pleasure to have this opportunity to share some of my remarks with you a couple of times a year, and I'm gratified that we have such a big turnout today. I think it's obviously a sign of the times, and we're going to spend most of our time talking about those times and the signs that we see. But I have had an opportunity of delivering one publication to you, the April edition of the CIPH HRAI Outlook publication, one edition since this crisis began. So there are some preliminary thoughts in that publication, but this is going to be an opportunity for me to talk a little bit further about what we're seeing and why and what the implications are. So the format of this particular webinar may not be, quite as identical to some of the other twice yearly webinars that I've been doing, because I have less focus now on kind of high frequency data and trends, because they're not quite as meaningful in terms of painting a picture for the near and medium term future. So with no further ado, I'll just get moving with my remarks. Now, the first thing to bear in mind, the first principle to bear in mind, is that everything is unprecedented. We see that word in everything that we read, and certainly in the first month or so. Now we're starting to see a little bit old hat or whatever, but there's still a lot of uncertainties. But nonetheless, what's happening to Canada now has never happened before, certainly not in exactly this configuration. The data points that are starting to come out now about the crisis period are data swings that we have never seen before, and a lot of this puts forecasters like myself in an uncomfortable position, because we like to take trends in the data, higher frequency data, and other information that we see, and liken it to previous periods, and to learn about the outcomes in previous periods in order to inform our view of how things are moving now. And of course, in an unprecedented environment, that's difficult. And it's not just forecasters like myself that are finding this. It's obviously business people like yourselves as well, which are finding that there's a wide array of information coming into you right now, both from your own sales channels, presumably, but also just information that's coming in, and it's very difficult to know sometimes what the next decision or the next step should be, because we haven't been here before. So bear that all in mind as I go through my comments, because it is an overriding principle. And I'll just kind of remind you about the Outlook publication. I think hopefully everybody who's on the line is familiar with it and has seen the most recent edition that has come out, and that's the one that's on the left of what you're looking at right now. And that one, as I indicated, has a commentary at the outset, written early on in the early days of this crisis, actually, that I put together. So some of what I've said in there has evolved a little bit, and that's what we'll spend some time talking about today, but still it does set out what we're thinking about. And the other thing I'm just kind of pulling up right now is the last couple of editions, because they both have lessons for what we're going through right now. This has been a good run, I guess, in terms of the topics that we've decided to cover. In the edition that came out in January, for example, we have quite a deep dive on the housing outlook and the kinds of factors that we kind of typically look at, and also how housing itself was geared up for 2020 and beyond. Now, of course, that publication, that analysis was done prior to, even knowing about COVID. But anyway, nonetheless, it sets up some lessons for us, because some of the things that we said in that publication is that a considerable amount of momentum was coming into the housing market, and that would give it some ability to withstand any kind of shocks, or some shocks that could be on the horizon. And we certainly were looking at some risk factors for 2020 at that stage, even though those risk factors didn't include COVID. But nonetheless, the analysis that the housing market itself had a fair amount of momentum, and that was going to insulate it a little bit from some of the shocks, I think is something that is a lesson that we still are using and taking forward. And then, of course, I was looking back, and in September, in the September edition of the Outlook publication, we put out an article about what a global recession would mean for the construction sector and then the plumbing and heating industry in Canada. Now, at that point in time, our remarks, first of all, we were looking at a possibility of a recession. There were some some recessionary indicators in the late summer, including a inverted yield curve and some other issues, and they seem to be primarily pointing at a global recession, not a Canadian recession per se. Trade wars and other factors were at play. So now we are in a global recession. Now we are in a Canadian recession, but for none of the factors that we said before, but the implications may be similar. And one of the key conclusions that I made in that publication was that we weathered through the 2008-2009 recession pretty easily, because we were we had high commodity prices at the time, and it was a financial recession, and we had a stable financial system, but not so much so now, because consumers are a little bit more strained, and commodity prices, of course, are low, and some other factors. So those were some of the risks that we highlighted in that publication, and they're still valid for what we're looking at today. And then I usually just take a quick look at the leading indicator, just first of all, just to kind of remind you that it's there, it's in the publication that comes out, but also it's an amalgam of a variety of high frequency data that we like to put together for you every quarter, just to give some sort of look ahead. And I will say that, in our most recent publication, the indicator was still strong. It had been kind of positive for sort of 4 of the last 5 quarters, remain kind of strong, although starting to weaken a little bit in the fourth quarter. We liken that to be a sign for fairly strong activity ahead. Of course, this all came in before all these this indicator really is being informed by data that was formed prior to COVID. So it has less applicability to the forecast at this point in time. And then finally, before I go through the remainder of my remarks, I want to stress a couple of principles or considerations. I want you to bear this in mind in terms of what I'm saying and why I'm saying it, and in terms of giving some kind of, confidence bands around the types of forecasts that we might be talking about. The first key consideration is very important, which is that, we're going to be talking about economic consequences. That's what we're going to be talking about, all throughout this presentation. But those economic consequences are very sensitive to the timelines of the health crisis. And as you might imagine, the timelines of the health crisis are still have a lot of unknowns around them. We might think, we're starting to get a good handle on what's happening in terms of containment measures in Ontario and in Canada and in the various markets that you might be in terms of the direction that the politicians, that your leaders are giving you, and that the health authorities are giving you. And it is true that most provinces now are in some state of moving towards opening up lockdowns in a gradual way. As we said in the publication back in April, that in the Outlook publication, we've always been targeting our forecasts around the idea that things would start to gradually open up as we go through sort of May and June, and that there would be kind of a substantial degree of normality in terms of containment measures starting as we go into July. And it looks like we're still sort of on that track, but there could be all sorts of changes or dips or doodles as we go forward. A lot of people talk about second and third waves of COVID. There still continues to be uncertainty about whether a virus is possible and what the timing for it will be, and those sorts of things. And that obviously will have an impact not necessarily on the opening up of current lockdowns, which we all pretty much understand that they will open up as long as we've got procedures to look after the infectious state of the disease right now, but not a vaccine. But we really need a kind of a vaccine to put this all behind us and get back substantially to normality. And whether that comes by the middle of next year or some other time continues to be unknown. And so these economic consequences that I'm going to be talking about to some extent are also very sensitive to that information. And I guess by way of saying that, I mean, I'm going to, paint some picture about how bad employment is and how fast it's coming back. But if we don't, open up the economy in kind of June and July as we kind of have predicated on this scenario, then of course it could be a very different outcome for when employment will be coming back as well. And then the second consideration is just this issue that diminished activity that we're going to be talking about, like housing or construction activity or whatever. There's two sort of distinct factors going on here, and I'll try to sort of address them as we talk about it. First is just shutdowns. So, initially, at least in some provinces, we had shutdowns of the construction sector. We've got shutdowns that are affecting supply chains towards the construction sites. We've got shutdowns that are affecting the approval process at the municipal level that is in turn then affecting the pace of construction and housing or non-residential starts. So all of those things are, important kind of physical restrictions, you might say, to getting a construction activity. And so there will be diminished activity to the extent that there are shutdowns from location to location of the nature I just described. And then the second thing are consequent economic drivers. That's obviously going to affect more in the medium term the capacity for housing and construction activity, because we're in a very deep recession, perhaps the deepest that we've seen in ever by some measures. And given that we're in this deep recession, we've got obviously household income is affected, consumer confidence is affected, and a variety of other consequences that you would expect during a recession, and that's going to affect housing demand. That's going to affect need for workspaces and things like that as we go forward. And so that's a principle I just want you to bear in mind, that everything is a kind of a balancing act between those two. How much of the diminishment is just a temporary thing that's going to come racing back? How much of it is something that we need to take into account for the sort of long, medium and potentially even longer term? The timing of the magnitude of the recovery, certainly in housing or in non-residential construction, it really depends on how much pent-up demand there is from the shutdown phase and whether that pent-up demand is being eroded by those economic drivers. So that's another principle. And then the other thing that we're going to be talking a little bit about and trying to put our mind to are kind of, to what extent are there structural changes in the economy, in the way that we operate, even our workspaces and all those kinds of things, structural changes that might be coming about because of this crisis, and what will that mean in terms of our need for construction and investment going forward across both residential and non-residential stock. And then finally, I'm going to share some remarks on international migration, because this now has kind of highlighted itself as a fairly big risk factor for us, housing market and employment markets, and the need for commercial space has been driven in a fairly large way in the last couple of years due to the surging migration numbers that we've had. Certainly this year will be much weaker just because of restrictions at the border, but there's some uncertainty as to what the future near and medium term future is for international migration, and that continues to be a little bit of a risk factor for us going forward. So into a few of the numbers just to kind of paint a bit of a picture of what's going on. We'll just start large at the world level. Very simple chart, somebody else's forecast. This is from the International Monetary Fund. They're describing this as the Great Lockdown is their description right now. Their current forecast, which differs quite a bit from the forecast that they put out just a few months ago, near the beginning of the year, is that the world economy will shrink by about 3% this year. And that's in contrast to their forecast that they had just a couple months ago, which was that the world economy would grow by 3.3%. So the delta is over 6 percentage points of global GDP being wiped out this year from this crisis. That gives you the magnitude of what that crisis is. That's a swing that wasn't even, there's only been one international recession since the Second World War, and that was during the 2009 financial crisis, and even that was not as big a delta, as big a swing as this. And this is a a quick one as well. But this pattern that you see into 2021, where the economy will be growing quite fast, kind of doing some makeup for losses this year, is an important one to bear in mind. This is this kind of pent-up demand that we spoke of a moment ago in terms of our principles. The idea that this is not whether you're talking about at the global scale or at the Canada scale, this is not a regular run-of-the-mill recession that is brought about by economic antecedents. There's in Canada, for example, we didn't have we didn't have a weakening economy. We didn't have reasons why the business cycle would be turning down, internal reasons. It's all just simply because of the containment measures and the health crisis. And so as soon as those containment measures come off and the health crisis seems to be abating, we expect demand to come back fairly strong. And so the IMF's view internationally has that same kind of pattern baked in, and that's what we're thinking about for Canada as well. So I'm just going to take a step back now as I move into Canada a little bit to describe the negative aspects of the crisis right now. Well, many of the aspects of the crisis are negative, but anyway, fairly negative aspects. And that's just looking at the workforce. In part, I'm going to show you, some perhaps a little bit more detailed data than we typically look at for workforce, but in part of the reason being that it's obviously the most important component of how this crisis is affecting our economy. It's affecting it through jobs, the loss of jobs and businesses that can't operate. But I just wanted to talk a little bit about the magnitude of that. And also, it's convenient to do so because employment data are some of the only economic data that we've now kind of had through the crisis period, because a lot of the more important or the perhaps the more robust data, for instance, on GDP and production and investment and all that kind of stuff, it comes out with such lags that we just simply don't know at this point in time, but we do have an idea about employment from the employment survey. And what I will say is, I'm sure you've been following that headline, is that if you look way over on the left-hand side, total employment is down 18%. 18% of people who had jobs in February no longer have that job. Again, I'll use the word, it's an unprecedented decline in employment over such a short period of time. That's almost 1 in 5 people in the Canadian workforce who had a job in February do not have a job at this point in time. And I will say that even that number may be understating the effects on households. In fact, it is understating the effects on households because there were certainly a lot of younger people who were in school in February who would normally be just starting their summer jobs at this point in time and are not. So you might want to add them onto that number, but nonetheless, 18%. The next bar over that says total hours worked shows an even starker metric that's coming out of the employment survey. And that is that if you look at the number of hours that people are working on productive activity, it's actually down 30%. So there's a lot of people who continue to have a job, but are not, maybe they've gone down to part-time. If they're self-employed, they may simply just not have any contracts to work on. If they're, maybe they've been furloughed for, 1 day a week from their company or whatever it might be, they're working fewer hours than they worked 2 hours. And that's almost a third of the workforce is in that situation, either having lost their job or reducing the number of hours that they're in. And then just going back to away from the hours, but towards the actual number of jobs, just a few kind of stylized facts. I won't spend a lot of time with it, but in terms of the size of companies, small business is being affected by this recession significantly more than big business. So, nearly 30% loss in employment in companies that have fewer than 20 employees, but it's more like about 10% when you're looking at the corporate Canada, the larger companies. And then by age, the youth is really bearing the brunt of this, almost 40% decline in employment by youth. And I will just reiterate what I said a moment ago. If you add on to that the fact that this age group would have a lot of people who were not employed in February because they were in school and would have expected to be employed now, and they still continue not to be. So it may actually be that this this effect actually is perhaps much more than 40, much more than 50, much more than 60% in that age group. And so that's a particular thing to bear in mind, and is troubling certainly for that segment. And we do have to sort of add, and we do want to sort of ask the question, you know, even as we come back more quickly later in the year, how quickly will that segment come back is an important question as well. Male and female is fairly balanced. It wasn't oddly in the initial month of data in March, but it is a little bit more balanced at this point. And then in terms of the broad public and private sector, it is this may not be a surprise, but the majority of the job losses, the vast majority, have been in the private sector, not the public sector, but there have been public sector job losses. I'll just highlight the final bar on here that says that self-employed, there's very little job losses. So just just put that off to the side a second. I'm going to talk about the self-employed a little bit more as we move on to the next chart. And in this case, I'll just say, going back to this previous chart, I did say if you look at this area here with the hours worked, I did say that there was about a 30%, 32% decline in the hours worked. So this chart just breaks that all out. So there's your same 32%. It's a different scale, so it looks smaller, but it's in this. Here, I'll just do this. So it is in this bit here. The goods and services sector are being affected by reduced hours to almost the same extent. And that may surprise you. There may be a kind of a perception that primarily it's a services sector recession. You know, we know restaurants and so on and so forth are being affected, but barbers and all that kind of stuff. But anyway, it's also, you know, the goods sector as well is seeing hours being reduced. So almost in equal measure, goods and services sector. And here we have employees and the self-employed. So actually the self-employed are a lot more affected by this recession than those job loss numbers would indicate. And so this is saying that it's almost 50%. So for those who count themselves as self-employed, they're not saying that they're unemployed, but they are working about half the time, half the amount that they were working back in February. And then just quickly, a kind of a scan across the different sectors. You may have a kind of a perception that all of the losses are in, you know, restaurants and retail and a few of those other kinds of small business that we hear about quite a lot. But in fact, it's quite across the board in many respects. And even the construction sector, where, you know, at this point in time, most sites across the country are not in emergency measures lockdown. Most provinces now are allowing, or all provinces are allowing construction to go, with some exceptions. But nonetheless, the amount of hours being spent by construction workers is down, you know, more than 40% from 2 months ago. And so that reflects the fact that these sites are just not operating at full capacity, and that will have an implication for how fast we can produce the housing and the non-residential space that's coming off of it. It's also an implication on the, you know, economic contribution from this construction activity, even though it's allowed to go forward. I'm not going to go through all the different things, but obviously accommodation and food services is the sector that is affected the most. Public administration, we're actually starting to see some gains in that area. And education is a kind of a weird swing one. That just has to do with the way the numbers are being counted. Most educators were off work in March when the employment survey was done, and then most educators are back at work now and working in a kind of a virtual environment now. So education is kind of back on stream, but most sectors across the economy are being affected in one way or the other. It's not a recession which is being just focused on those you know, Main Street type businesses. Okay, so to move back up a little bit on macro side, then I'm not showing very well here where the historical and the forecast marks, but of course the Q1 data are historical data. We did see employment fall a little bit into Q1, but the Q2 data is where we'll see a big decline in the numbers, and then we'll start to see employment coming back in sort of the end of Q2 and starting Q3, we'll see some job gains. But our expectation is that those job gains will not retrace back to where we were at the, even in Q1, we won't retrace until we get well into next year. And even by the end of, even by about the third quarter of next year, we won't be, past the peak of where we were before. So it's going to be about a year to sort of see a lot of those job losses start being retraced. On a kind of an annual basis, then we'll certainly see much lower employment this year, and then next year we'll have employment back up pretty close to around the 19 million jobs that we had prior to the crisis. But as I'm trying to illustrate on here, we had expectations in our previous forecast that there would be close to about 19.5 million jobs by the time we get to the annual average for 2021, and we'll be, about 600,000 lower than that. So there will still be quite a large number of people who would have been employed by the end of next year who will not be employed because of the crisis and the lingering effects of the crisis. And that really is kind of going to get to the components of this crisis that will have a longer and lingering effect, despite the fact that we will, solve the immediate problems of the health crisis, that there will be this lingering economic effect. So I'm going to try and speed this up a little bit now. I have gone slowly through this because I think this is very important to know how this has kind of been transpiring. GDP, I won't go through the details, but it's a similar kind of pattern. We're in the middle of the second quarter now, and this is where the deep dives on the economy shrinking is taking place, much more so than we've sort of ever seen before. And we're probably in the middle of about a 3-quarter recession. Overall, we're seeing the economy shrink by about 25 percentage points or something in total over this period of time. On an annual average basis, it's going to be, for the annual as a year of a whole, that will bring it through to about a -7% GDP number for the year. Pretty severe, and you can see that's about twice the amount that IMF was saying for the world economy as a whole. So that's something to kind of bear in mind. Canada will bear a fair amount of this brunt, and a lot of this is also the timing. We don't think, as you can sort of see by the sculpting, even though by the fourth quarter we see some improvement in production. I mean, quite strong improvement actually in the up to about the 4% range, that we won't be we won't be really kind of having a substantial amount of the recovery until 2021. And even then, it's not going to be as much to counteract it all. So again, on an annual average basis, about 5% growth next year will seem like a very strong year from a historical economic growth perspective, but will still not even be enough to make up for the losses this year. And this is another view of that to sort of see what that means in terms of GDP. We had an economy at the end of last year that was about $2.1 trillion. And by the end of 21, we won't even be back to that level. We'll just be gradually growing the economy, but it will not be back to the level that it was prior to the crisis. And then this is just a slightly kind of different view, just to sort of see how that all works out. So we have a decline that is largely being driven by the household sector. So people are spending considerably less. I mean, nobody's spending in restaurants, nobody's spending at the mall. Income of, up to 30% of people, as we said before, is being affected in one way or the other. But we also have a massive amount of government stimulus going in. We've got about $200 billion worth of income support payments going out currently and over the next few months. And so that's counteracting. Those are positive effects from a GDP perspective anyway. And then that's where you get that net result of about 25% decline in economic growth. And then we'll see the recovery as we go forward being driven fair amount by investment, because this will be the housing starting to come back and the construction. And perhaps as we go further on, I've kind of neglected to mention, but we're also in the middle of an oil crisis, of another oil crisis in the West as well, with very low oil prices. But we do see investment in that sector starting to come back as we get into early next year as well. So that will start to bring some of those positive effects as well. And then just a bit of a provincial review. You know, Alberta will be hit hardest because of the dual nature of the crisis. And Quebec was hit fairly hard and had more restrictive lockdown measures, at least initially, and that's going to affect this year's GDP. Other parts of the country, more or less in that kind of 6 to 7% range decline. Everybody was expected to grow from our prior scenario, but they're all regions are expected to shrink this year. Next year, everybody is supposed to recover, except Alberta will still be a negative economic year next year, and a big delta on Alberta as well, because we had previously expected Alberta to be growing by about 3.5% or so, and it will continue to be a negative year next year. Just a minute or two on population. I just want to remind you, and I think I probably have showed you this chart before, or some version of this chart before, but I just want to remind you that 2019 was a record year for population growth. Well over 500,000 net new people in the population, and the vast majority of those were international net new migrants. I mean, either immigrants or non-permanent residents or other components of international migration, but nonetheless a strong number. And that had been building steadily over the last 5 years. You can see it's twice the rate that it was 5 years previously. And obviously population growth has a huge influence on housing need. It also was fueling the employment growth that had been taking place prior to this recession. And it also fuels, across, the need for workspaces and all the rest of it. And so the construction sector was benefiting tremendously by the growth, this pattern of accelerating growth. And we don't have numbers yet for where migration is this year and where it's going to be as we move through this crisis. But the borders are largely shut. It's still possible for international migrants to come under certain circumstances, but certainly the friction from this crisis will mean that this will be a very low year for international in-migration. Whether that races back next year or into 2022, perhaps, back to this kind of accelerated pace. We'll see how that evolves. I suspect it's probably going to be weaker now for at least the medium term, the next couple of years. And I think that will definitely have an impact on the pace at which we, need to build houses, and then certainly in terms of the demand for both on the rental side and on the ownership side, the demand for housing as well. And it will also have a dampening effect on our ability to grow our labor force as well, and our need for workspaces and all the rest of it. So a little bit more about that as we go on. Interest rates, bond yields, as I think most of you know, have went down precipitously at the onset of the crisis and have started to come back up a little tiny bit, but continue to be, at historic lows. We will start to see bond yields tracing back up, I think, as the economy recovers. But I think even by the end of next year, we'll still see bond yields being well below their kind of 2009 levels. And sorry, this is where we were right here. Well below the 2009 levels, and certainly well below where we were, what our prior forecast. We had expected interest rates to kind of, be fairly steady this year and then start to rise as we go through next year. And we may still have that same kind of pattern, but at a much lower level. Mortgage rates, though, for consumers have not followed the same pattern. They actually rose pretty sharply at the onset of this crisis, and that represented risk factors. Even though the cost of funds were lower based on the bond yield, the risk factors for banks lending to the residential market, at least at the onset of the crisis, seemed pretty elevated. I think those risk factors may be going away, or at least becoming less acute as information about the crisis starts to become better known, and the banks have a better idea about what default rates and things will be. We'll start to see those mortgage rates come down, start to retrace towards the lower bond yields. And I suspect we'll probably be seeing an environment for mortgage rates as, at the end of this year and into 2021 that will be, not tremendously lower than where we are right now. I mean, I'm still talking about something in the 2 to 2.5% range. Sorry, 2.5 to 3% range, but nonetheless, perhaps more moderate than even what we were expecting in terms of normal rate rises into 2021 prior to this scenario. And housing prices were escalating pretty sharply from about the middle of 2019 through to even the most recent data we've gotten now for March, at least for the full data across the country in March. Housing prices were about 7%, up about 7% year over year in March, and that represented that same trend off of the middle of last year. Housing prices themselves have been very affected by interest rates. So interest rates were quite low in 2016, early 2017. And we saw, housing prices escalate quite a bit at that point in time. Then interest rates started rising fairly precipitously in the mid 2017 to mid 2018 time, and that certainly brought housing prices, at least moderated them on a national basis, actually made them negative in a few markets, and then we've seen as interest rates have kind of come back down, we've seen this pattern where prices are starting to rise again. I think in terms of the impact of this crisis on pricing, it's very nuanced. I have a huge range here. I mean, I think even by the end of this year, we could see negative values, or we could see positive values up in that 5% or 5% plus range. I think the preponderance of the risk is more at the top. I think we'll probably see housing prices being positive and perhaps even looking a little bit frothy as we go, certainly at the end of this year or into next year, because we'll have the pent-up demand from people who just couldn't purchase during the lockdown period. We'll have more supply coming on stream, but it may still be a little bit constrained, and I think that we'll probably see more pressure or upward pressure on prices than down. But I do have a fairly large range here, so that is something to kind of bear in mind. Now, I shared a comment with you early on about the fact that the resiliency of the housing market going through this lockdown period, and then what it's going to look like in the post-lockdown period when we still have social distancing measures, we have economically impacted members of the public, of the potential home buyers. And yet we have also a market that had a fair amount of momentum going into it. So here's an illustration of just to get an idea that it's not universal across the country. Certainly the prairie markets, we've seen even on a 5-year basis, we've seen housing prices, at best being kind of flat or a little bit negative. But many other markets across the country, we've seen prices in that kind of 7 to 10% range on an annual average basis over the last 5 years, kind of illustrating the kind of momentum that a lot of these markets had. So there is some room for price adjustments in markets like Toronto and Vancouver and Ottawa, even from any kind of adjustments that took place, in the price adjustment period after 2017. There is room for some additional price adjustments without putting a lot of homeowners underwater. But I also think that this is a bit of an indicator that there continues to be, that underlying momentum that was driving prices up right through into March. And even though the whole market will be on ice, will be kind of, a bit scattered for the next few months, that once we start getting some normality, I think we'll see numbers back in this range again. The volume of sales will certainly go down. We're looking at about 420,000 home sales or resales this year, down from pretty close to 500,000 last year, and certainly down from what we were expecting for this year. And you can sort of see the pattern. I won't go through quarter by quarter, but certainly very low this quarter. I mean, it's very difficult to buy a house right now in many markets. And we'll get some catch up, I think, near the end of the year. But even as we go through next year, it'll be a bit weaker than we would have expected before. And that's really just that's the economic antecedents coming through. There will be the pool of potential buyers will certainly be affected by this recession, and that's why we'll see sales will rise a little bit into next year from this year, but they won't be anywhere close to where perhaps they would have been under circumstances if we hadn't had this crisis. And then starts a fairly similar picture, I guess, in many respects. So I won't repeat the whole pattern for you, but weak now and then starting to come back is the main thing, but not coming back and meeting to the period that to the point that we were expecting before. So we were expecting about 220,000 housing starts next year before. Now it'll be closer to about 200,000 next year. And this year is about 150,000, which actually is pretty similar to what we had in 2009. So this year will look similar to 2009 in terms of the depth of the housing recession, at least in terms of the way that it affects housing starts. And then just kind of a quick review by province. I mean, it's a fairly similar pattern almost everywhere. BC, Alberta will come back, but not very strong. It'll probably take a few more years to kind of come back. I think the rest of the prairies probably will do quite well next year. Ontario continues to be pretty strong, probably less impact overall. Certainly the April starts numbers were surprisingly high, and that was a month that was severely affected by the lockdowns. Quebec as well, we'll see that come back pretty strong after the lockdowns are over as well. Atlantic Canada will also come back. A fairly similar pattern all around. Rental markets, I won't speak too much to this, but vacancy rates have been declining pretty significantly the last few years. And at the same time, we've seen a big ramp up in construction of rental buildings, nearly 50,000 housing starts last year. That's getting pretty close to what our need is. We think that our need is about 50 to 60,000 per year. So I suspect that this number will start to level off a little bit. I think the multifamily market will be a bit soft, and the rental market will be a bit soft in the next few years. I think it's probably the component of demand that will be the most sensitive to the recession, and so we might start to see a little bit of a slowdown in terms of the investment intentions into purpose-built rental. So that's something to kind of bear in mind. And then just a note or two about renovation. Obviously the same pattern as before, down this year, up next year, but next year is nowhere close to what we were expecting prior to this. I mean, renovation can be very influenced by income and GDP, and that's driving a lot of this forecast number. In the short term, there's going to be just an issue of people making decisions, not just from an economic perspective, but whether they want renovators in their home and those sorts of things as well during the time of the health crisis. So anyway, I do feel like we're going to be taking a pause on renovation over the next couple of years in terms of that traditional growth path that we have seen. And we'll probably see it be fairly flat even by the end of next year on the renovation side. And then just wrapping up quickly on ICI. A couple of stylized facts, first of all, over here on the right, just as a reminder, ICI construction represents about 1/3 of overall construction investment. Residential is the other 2/3. And of the residential, about half are singles, half are multis, but amongst the ICI construction, most is commercial, and then a little bit of institutional and government, and then industrial as well. And the growth over the last few years has been fairly steady, and that's been coming out of both commercial and also industrial. Industrial more so in 2018, commercial more so in 2019. And so far this year, which is only January, February data, up a little bit more even over last year. Now, of course, there's a lot of issues with commercial construction and its possible outcomes from the crisis. And I just thought I would illustrate a couple things to you right here. One is, this is a slightly different view than what I just showed, but shows how commercial has been driving the growth through 2019. You did see that in the last chart, more so than overall non-residential. It's been pretty rapid growth on a quarter-by-quarter basis, so it had a fair amount of momentum going into here. But we have an awful lot of office space in particular, which is now in the pipeline. And I think, I try to think about what responses the industry might be making to possible changes in office demand going forward related to the health crisis and what that means. I mean, a lot of people are talking about how companies will be shifting a lot more to remote workers and these types of things that could decrease the need for space. And yet at the same time, we've got a pipeline of nearly 50 million square feet just in these major markets across the country, about 50 million square feet of stuff which is either under construction or being planned in terms of office space. And so there's an awful lot of office space coming forward, and we might be just at the precipice of a kind of a major change in our overall need for office. So I would not be surprised if at least we see a little bit of a pause in investment intentions. I'm just using office as an example here, but I could share all those same remarks for retail, which I think a lot of you may realize there are a lot of questions around right now about the way the retail real estate segment will evolve in the next few years in relationship to changing shopping patterns that could have been, exacerbated by this crisis, but were already in place before. And here's office, the same sort of thing. So I wouldn't be surprised if it's a kind of quite a weak environment in the next 2-3 years, at least for ICI construction, because there are so many uncertainties as far as our longer term needs for that space. And I'll leave you with just a couple of food for thought things going forward, sort of longer term things. One thing that I will say is that a lot of people have been talking about work from home affecting office space, and I just addressed that myself at the last slide. But I want you to think about the way, if we are moving to a more work at home or remote work kind of environment in more of the medium to long term, if that's a kind of a structural shift that might be coming about from this crisis, and some people say that it is, I'd like you to think about not just, the effect on the need for office, but what is the effect on homes? Is that going to shift demand more into ground-oriented or larger homes because people realize they need the space in order to undertake a proper remote work or work at home kind of environment? The pandemic has exposed the vulnerabilities of high-rise living in some people's minds. Will that be a lasting impact, or is that just a kind of a short-term thing during this lockdown period? We'll all see. But anyway, it's just food for thought at this point. And the same goes for sort of, urban density in general. I mean, does remote work mean that the premium that people pay for living in downtowns as opposed to a suburban or even further afield environment, does that premium start to go down? And we'll see how that's an interesting thing from an urban development standpoint. Retail, hospitality, entertainment, some things are going to come back and be normal, I think, after a year or so, but some things may change dramatically. And so we have to think about the way that that's going to kind of affect our communities in general, but certainly the need to invest in that type of space and the type of construction opportunities that there will be going forward in those things. And then the final thing is just seniors housing. And I don't even know what all the answer is, but this crisis has exposed a lot of vulnerabilities in that sector. And I think, over the medium term, what we will see is a tremendous amount of new construction as we try to fix that infrastructure into something which is a lot more resilient to crises like we have right now. And so that might actually be a big opportunity for investment. So we'll see what happens on that one as well. So I've gone a little bit later than I wanted, because I wanted to leave about 15 minutes for questions, but we do have time for questions, and maybe I'll turn it back over to Sarah to handle that process, and I'm happy to hear from you. Thank you very much, everybody.
Thank you so much, Peter. We actually do have some questions already coming in. So the first question is, are we in a recession or a depression, and what would be the difference between the two?
Yeah, I'm going to say recession, first of all. I mean, technically, we're not even in a recession yet, because a recession is something that, you count after the fact, generally, because it's usually defined by the length of time that the economy has been shrinking. So we're said to have gone through a recession after it's shrunk for 2 quarters. And we're just into the, it started to shrink in March. So we're really just a few months into the shrinkage of the economy. But as I showed in the chart, I'm fully confident that we're going through about a 3-quarter length recession. So that is a recession. I would not say depression. Again, you know, the definitions of these things would be more after the fact anyway. But you know, we really only have described one thing as a depression, and that's the Great, well, in modern times, that's the Great Depression in the 1930s. Even the crisis in 2009 in the U.S. was not is not thought to be a depression, and the reason is just longevity. I mean, depressions. I mean, it's not just the depth of them, but it's how long they go on, and they go on for a long time because there's a lot of self-sustaining, negative self-sustaining factors that go on. I mean, the aggregate demand goes down, and then and then you don't have the supply chains, and then nobody's producing stuff, and then you can't have, and then people can't have demand anyway. It just feeds on itself, and people's incomes are lower and lower and lower, and it just feeds on itself. And this is not in any way, shape, or form that same kind of. This is not a regular, run-of-the-mill business cycle related even recession. I mean, it's a recession which is brought about, strictly speaking, because of the containment measures, the lockdown of certain parts of the economy for a defined period of time that will come off, and then large parts of the economy will come back on stream fairly quickly. It'll take a while for other parts of the economy to come on, like the restaurant sector, I think, will be quite affected, and others, but nonetheless, it's not a negative spiral, self-sustaining kind of a downward spiral in terms of the economy. It's not that at all. So it is not a depression.
Okay, a second question. As the employment numbers move back towards prior levels, will people be as fully employed as they were before?
Yeah, I think so. I mean, bear in mind when I showed you that chart, I mean, it's quite a few months off even before it's near the end of next year before we even get back to where we were at the end of 2019. So it's quite a lengthy time to regain all those jobs. And importantly, the employment rate will be still lower at that point than it was before. So there will be, the employment rate is like the proportion of the working age population who are employed. It'll still be lower. So those still will be people who would have normally been working who aren't. But for those who are, I think hours of work will start to normalize back to where they were. I don't see that that's going to be a big issue. I think that there's going to be a wider spread use of remote working. I mean, remote working right now is said to be about 45% of the workforce is remote working in one way or the other right now. And then, there's about 35% that, that are just sort of can't remote work because it's a more of, proximity type work. I mean, it's hard to remote work when you're in construction or retail or whatever. But anyway, I suspect we'll see a little bit more there where, a broader array of sectors might be able to remote work as well. So anyway, I suspect that the hours worked will start to normalize as the economy comes back on stream. But the lasting effects of the recession will simply be that we just won't get that employment rate back up to where it was. I mean, certainly not in the time period of this forecast. It'll probably be beyond the time period of this forecast.
For the recovery, what is the anticipated impact of the green, clean energy sector for Canada's economic recovery?
I don't know if I even have an answer to that. It's not something that I have looked at all that closely. I would say in general that that a lot of these things are marginal. There may be environmental benefits that are tremendous if we were able to make the transformation in a wholesale way. But I think the transformation is probably slower than a lot of advocates of green energy would like it to be. And as a result of that, the economic benefits of that transformation also will sort of be marginal and over time. So I'm not sure if it's going to be playing a major role in terms of the stimulus that gets us out of this this recession. I think the stimulus that gets us out of this recession will be just an awful lot of like regular businesses just coming back online and people starting to produce produce their work in a somewhat back to normal, and incomes starting to normalize again, and then and then we'll start seeing people consuming and those sorts of things again. So I don't think that niche industries are necessarily going to play a huge role in that.
With the unprecedented national debt being accumulated and the potential for large tax increases, do you see this as having a large effect on a recovery?
I don't think that we'll see the fiscal impact come through in taxes in the kind of short to medium term. I mean, I think in the end it may have a long-term effect on tax rates. But bear in mind that a lot of the stimulus that's being done right now is going to be kind of financed through quantitative easing. So it's not necessarily all going into debt. I think it's a bit too early to wait, too early to make a huge call on that. I think we got to get the economy recovered and back up and running, and then kind of strategically figure out how we're going to deal with, on the quantitative easing side, we're going to have to deal with all that monetary stimulus that's in the economy, and on the fiscal side, we'll have to deal with the debt that will have borne the weight of the 200 billion or so that's coming out of the stimulus packages.
Okay, I'm going to read this question word for word. With the groundhog coming out of his house every day at 11 and throwing money at everything that moves, how will this ever be repaid? How will it affect our dollar? Has he missed giving some to any groups around the world?
Well, I think my last question kind of answers that. If the core part of that question is, that if we have $200 billion in federal income support payments going out, which is around what it will be, what will be the federal strategy for paying that off over time? I mean, that's going to be, and I think it is like any other government debt, right? I mean, you've got bonds, and you're paying. I mean, if anything, they've got quite low interest rates right now in order to float these bonds, so that mitigates the problem a little bit. But without a doubt, it's some additional debt, and it's something that we'll have to strategize our way out of. I don't think it's of monstrously negative implications on us, but is it better than if we didn't add $200 billion to our debt? Yeah, I guess it would be. I guess it's a little bit worse than that.
What impact will lower tax revenues have on the public employment sector, and how have you modeled that into your projections?
Well, we've seen some. I'm not sure if I've modeled it into the projections much at all, but because that's more of a sectoral question. We have seen some job losses and hours losses in the public administration sector, and that's reflecting the fact that there are a fair amount of public sector jobs that have been furloughed, and some of that is in light of the fact that at least at the municipal level and at the federal and provincial level as well, there will be reduced tax revenues. But this is just, this goes into that same question about, what will happen in terms of government debt. It will go up. Will it go up by an unsustainable or an insurmountable amount? Probably not.
Will government deficits reduce the amount of incentive funds for homeowners and business owners to switch to lower carbon footprint fuels?
I'm not sure if I understand the question per se. So maybe repeat it. Is the question about? Actually, maybe repeat it because I'm not sure if I caught that.
Will government deficits reduce the amount of incentive funds for homeowners and business owners to switch to lower carbon footprint fuels?
So the questioner is sort of pointing to certain provincial programs that exist now, or in some cases perhaps might have been kind of on tap to come forward to incentivize the switching of heating equipment in the home towards a greener equipment, and whether those programs will be shelved. I think it's entirely likely. Maybe not across the board, but I think that as governments deal with higher debt levels and over a medium term, as they've strategized their way out of that, perhaps there will be, fewer incentives for some of these types of programs that are perhaps not core programs for, at least in terms of kind of core economic management type programs. So yeah, I suspect that you would probably put a risk profile around losing some of those programs, or about some of them not materializing in the way that that you would expect them to.
What will the shape of recovery look like? Will it be a V, a U, and a W, or a Nike swoosh?
Well, I mean, the shape is, I mean, if you remember that sort of chart at the beginning, I mean, I guess that's where the shape comes in. I would describe my shape probably as being a bit more of a V than either the U or the swoosh. I think the swoosh piece is the one that says that we're going to be down and out for several quarters, and then things will start to come back fast. What I have said is that things will be coming back on stream kind of later this year, and be strong, going through the middle of next year. So I think that you would describe that as being a V.
And Peter, will the shape be the same for the recovery as it relates to construction?
Well, the construction, again, that's, I guess, kind of goes back to some of the chart. I had the chart on housing construction, and that also had housing starts coming back fairly strong by the beginning of next year, right? So I think that would also be described as a V-shaped construction. But I think that the decline in housing starts, and perhaps more importantly, the actual pace at which construction is taking place, because we do think, even though a lot of sites are operating right now, that they're operating at 50 or 60% of capacity, so certainly not at full capacity. But I think that as lockdowns start to come off on a more widespread way, and as the home sales and others start to put a lot of demand on making sure that we produce a lot of this new space, that you'll see construction sites really ramping up later in the year, early next year. So I would say that that's a V shape as well.
Do you feel the impact of this is something that will affect contractors 3 to 4 months in the future? We have not been affected yet, but we are concerned about the long-term effects.
Well, it's interesting that the questioner says that they haven't been affected yet. I mean, I guess I could see that there's going to be, lags for contractors, right? Because you typically get contracts sort of at the advance of a construction project, and then you would come in, come in after that. And so if there has been a slowdown in projects, that might be affecting things 2 or 3 months down the road. But I think that the slowdown on sites would also be negatively affecting contractors, right? So it might not be that a site is shut down, but if a site needs to be operating at 50% capacity because they can only have one trade on the site at a time, or if they have to have people spaced out in a certain way or whatever, then you'd think that that's going to affect contractors and the pace at which they can get onto sites in order to do their work. I'm surprised it's not hitting yet in the questioner's mind. Maybe it is for some, maybe it isn't for others. But I would expect that these effects will be a little bit longer lasting, because we don't have a real end in sight. I mean, we would hope that it might be sometime next year that that we can kind of move beyond social distancing measures because there's a vaccine or whatever else. But we don't really have that timing, well locked down yet. And I think that that's going to be the kind of thing that affects contractors perhaps a little bit more so than the top level construction numbers that I mentioned, because contractors need to get on site and they need to, operate alongside other contractors, and those are the types of things that would be, that would be affected by the slowdown by the these sites not operating at full capacity.
Peter, I know that we're over time, but I hope it's okay that I ask just a couple more questions.
Sure, it's good with me if it's okay with all your listeners.
Perfect, and we still have the majority of people online, so I think we're doing okay. Has the federal government response been on par with other countries, or are we leading the pack?
I'm not sure if I've got an answer to that because I haven't looked at things from that perspective. Certainly, all countries are engaged in income support programs of one sort or another. They all look a little bit different, but in terms of relative magnitude, I don't know if I've got a good answer to that. Yeah, I don't know. I suspect that they're all, fairly similar.
What are your projections for the US dollar and Canadian dollar exchange rate?
Well, it's always difficult. It's always, right, I should say, it's always just dangerous to even go there. But what I will say is that from a kind of long historical perspective, the Canadian dollar tends to just follow the oil price, which is, of course, quite weak right now. And will we see, oil coming back with some strength in 2021 as the world economy starts to pick up again? That 7% growth that the IMF was talking about. Yes, I suspect the oil price will respond to that. It may not go right back up, but it'll certainly respond and become stronger. And so I think it will see the Canadian dollar start to come up at that point in time as well. But what that means, where are we going to be at 75? Or are we going to be at 80 cents again or something like that? I'm not sure. Probably something in that range.
Do you see opportunities from a protectionist mind frame in Canada versus an economic globalization? Or will the economic globalization continue as it was pre-COVID-19?
Well, I'm just putting my mind back. I'm just trying to think. I think when I presented to your group about a year ago, maybe in the spring of last year, I think I shared a bunch of remarks about globalization. And at the point in time, I mentioned this new word people were using at the time. It was in the Economist magazine, others, called slowbalization. That there's this kind of internet that's starting in about 2016 onward. There was this kind of demonstrable slowdown in the pace at which globalization was taking place. In fact, really a reversal of what we had seen over about 15 years and of growth and globalization. And and characteristics of this globalization involved the trade wars, for example, which have been characterized the last 4 years, certainly 4 years of time internationally, but also security risks, starting going back quite a number of years, but security risks that have kind of slowed things down, diversification of business diversification, which has sort of led businesses to keep larger operations in at home and things like that. So there are a number of these different kinds of factors, and so this crisis and what effect it's going to have overall, I think that it's going to be kind of similar to other aspects of these longer term questions, just like retail shopping and office space use and the others, is that if there's a trend taking place, this crisis might actually exacerbate that trend a little bit. So we've definitely seen a trend for a number of years towards less globalization. And there's certainly aspects of this crisis, at least in terms of what people have been pointing to, that would lead to even less still, lead to countries trying to be a little bit more self-sufficient. We've heard, for example, for those of you who are in Ontario, we've heard Premier Ford's talk about a reindustrialization strategy to bring manufacturing back to Ontario and have self-sufficiency. We've heard similar comments from the Prime Minister, and there have been other premiers as well. And this is taking place all over the world. And so that is really kind of the opposite of globalization, right? If you're trying to become self-sufficient in your own jurisdiction, or at least a little bit more self-sufficient, that's taking it a different direction. So I think this is one of those things that will exacerbate the slowbalization, which actually really has been a trend for the last, half decade or so.
There was some discussion on global movement. How will this factor into housing starts?
So what was that word, global movement?
Yes.
Oh, of migration. That's migration. So my comments on migration, first of all, I don't have a strong forecast for what's going to happen. I would like to get some more direction on, both from, well, anyway, just from the data as it starts to emerge, and also from, federal policy, and also from, international events, right? I mean, if that can affect the way other countries or the way other continents go through this crisis over the next year or so, may also have an impact on, the pace at which we, benefit from either more or less immigration, or more or less, movements of non-permanent residents. But if it's a lot slower, I mean, if it goes from the 400,000 persons from last year that came in back down to 200,000, then that has an immediate impact, both in the short and medium and even longer term, in terms of what our base demographic demand is for housing. So you take 100,000 people out of your population growth, then you're going to certainly slow down the need for housing over the kind of medium term. So we have to watch that very closely, and that's what we're doing. But we need to get a better sense right now about whether this crisis is going to be just a blip in terms of our immigration profile, or whether it's going to have a more lasting direction. And I just don't have that yet.
If we run into a second wave of this virus, how will it impact the current schedule to be back at full production by the end of next year?
I think it'll slow it down, but bear in mind that when it hit us in March, we were largely unprepared. Now, you can have a debate about whether we should have been better prepared and we should have learned from China and this and that and the other thing, but we were largely unprepared. We didn't have, most of the infrastructure in place in order to handle, elevated infection rates, in order to handle work at home, in a large way, and all sorts of other things. And I think a lot of companies did, very well in terms of transitioning their workforce to work at home. And I think governments did, as well as they could, perhaps, in terms of, trying to, manage the process from the hospital perspective and all that kind of stuff. But I think the thing about second and third waves, or subsequent waves, is that there will always be these flare-ups of the virus. That's what we're being told by the epidemiologists. They will come, but they're going to come into our communities that are set up with better infrastructure to deal with them at that point in time. We're going to be kind of like virus ready, and whether that means that we're able to quickly, much more quickly shift to to remote work if need be, or much more quickly deal with containment of community transfer, because people are already social distancing and those sorts of things. I don't know. I think that there's a real case to be made that the subsequent waves may have impacts in terms of the number of people who get infected, but may not have as much of a impact on the economy, because we might not be in a position where we need to do lockdowns per se. So it's all very speculative at this point, but my guess would be that it's not going to have as much economic impact in these subsequent waves.
The stock market has bounced back about half the low drop in March. Do you feel that it is too optimistic, and based on lower earnings for most companies going forth, the stock market is too optimistic? Would you expect a drop in the market much lower?
Well, it's not really my area to call stocks. That's the thing. So I can't comment too heavily on that. It surprised me that it came back quite as much as it did. But it's there are a lot of factors going on there. I think that if you're concerned that it's a bit of a false bounce, and that as soon as the longevity of this crisis really really hits everybody's, all the companies' bottom lines, you're gonna see things go down again. Maybe I'd suggest you get into something safer for at least for the short term. But it's not my field to do financial advice.
What is your forecast for housing completes? Would it drop 25% similar to starts for 2020?
Yeah, I haven't done the work on completions yet. So 2020, I don't think it'll be as much of an impact. I think it's going to have more of an impact on 2021 because because the completions for 2020 are generally all stuff that's in the pipeline. Everything's got started last year for completions this year, or the year before. It's about 2.5 years for multifamily, about 9 months for single family right now are the lags. And so, to the extent that we're going to see, maybe 3, 4, 5 months of diminished housing starts activity in the middle of this year, that's really going to be affecting completions if next year and beyond, not right away. Now, what will affect right away is just sites that have had to slow down production. So maybe some things that would have been completed in the fourth quarter of this year will tip into next year, and we'll probably see a little bit of that, but it's not going to be 25%. I think it'll probably be down about 10 or 15% max.
Is there any hope for our friends in Alberta and Newfoundland?
Yeah, I think that there is. I think that I think we're overblowing the oil crisis to a fair amount. There's a lot of very negative, talk about it. But this thing started. I mean, there was some sense at the beginning of this thing that it kind of got started because of a bit of a trade war between Saudi Arabia and Russia on oil. But by and large, it got started on the fact that the economy is shrinking at 3%. The world economy is shrinking at 3%, and the part that's shrinking is very oil dependent. So the needs for oil have gone down, dramatically. As we go through this crisis, not just we, but across the world, everybody's going through this crisis. Next year, the economy is growing at 7%. And, where that growth is going to be picking up is going to be all in very oil dependent sectors, transportation, manufacturing, all these kinds of things. So, yeah, don't underestimate how fast oil will come back. Now, whether Western Canada benefits significantly from that, because there's always this kind of issue about getting the oil to market and the pipelines and all this kind of stuff. So, but that's, leaving some of those issues aside, I think that we'll see the oil sector coming back pretty strong next year.
One last question, Peter. Any thoughts on government stimulus spending on construction to stimulate the economy?
Haven't heard anything yet. I suspect the industry is getting themselves into position to put suggestions forward, and probably for good reason. I mean, we've seen it in the past that construction-related stimulus efforts can be very beneficial for getting out of a recession. So in 2009, for example, we saw the renovation tax credit that was basically a construction incentive, and it worked really, really well. We had about 25% growth in renovation expenditures during that tax credit period that really helped to bring a lot of communities out of the recession. In other times we've had other things that have kind of like in the early 2000s we saw a lot of the macroprudential rules trying to juice up the housing market a little bit, longer amortizations and things like that. And I think we might see some of that kind of work as well. But I don't know what's on the menu this time around. There hasn't been any talk yet from governments about what they may do, and that would really be something that kind of comes out during the recovery phase to kind of boost it. Remember that housing is a huge has huge multipliers to it, right? That every new housing start has about 2.2 jobs that get created from the start. So if you can boost housing starts by 50,000 units by a kind of an incentive program of some sort or another, then all of a sudden that's more than 100,000 jobs that get created. And so So I wouldn't be surprised if it's going to be on the menu, but I haven't seen any direction for that yet.
Thank you so much, Peter, and thank you so much for everyone that is still in attendance and listening. If you have any questions that come up afterwards, please feel free to email them to info@ciph.com, and I will be sure to forward them off to Peter. His contact information is also on the screen right now. We will be sending a copy of this recording to everybody within the next couple days, along with a survey. So if you could fill that out, that would be fantastic. Other than that, thank you so much, everyone, once again, and I hope you are all doing well and staying safe. Thank you. Bye-bye.
Thanks, everyone.